Hello, my dear aspirants. To assist you in economics preparation of COA 80, I am here with an easy explanation of your difficulty areas. Today in this session, we shall study about national income. So these are the basic portions that I am going to cover in this session. The concept of macroeconomics, circular flow of income, definition of national income, concept of GDP, GNP, NNP, and NDP. Now, the last one is measurement of national income. Now, let's talk about what is national income. So, national income is the money value of all final goods and services that is being produced in the domestic territory of a country. Now, what is macroeconomics? So, the macroeconomics we can bifurcate into two words, that is macro and economics. Macroeconomics, the word macro came from Greek word macro, that means large, and economics is a branch of economics dealing with the performance, structure, behavior, and decision making of the economy as a whole. So, whenever we talk about macroeconomics, that means we are dealing with the aggregate or as a whole in the economy. That means we are talking about macroeconomics. Examples would be unemployment, national income, inflation, etc. Now, let's talk about what is two sector model, three sector model, and four sector models in circular flow. So before going deep into dive, let's try to understand what is the concept of circular flow first of all. So coming to the point of circular flow of income or circular flow in a model in which the major exchanges are represented as flow of money, goods, services, etc. between economic agent. In circular flow, there are generally four sectors in the economy, such as households, firm, government, and net exports. Now, let's try to understand the two sector models. The name itself telling you the two sectors model, that means consists of only two parts, that means households and firms. Households and firms, we can see here that there's no role of government because we are talking about the two sector models. And if there is no role of government, that means there is no role of taxes and subsidiary as well. So here you can see that in two sector models, it is assumed that households spends all their incomes and consumer expenditure purchase the goods and services produced by businesses. Thus, there are no taxes, savings, or investment that are associated with other sectors. You can see in these three sectors that there is a role of government and financial system. Why? There is a role of government because in this sector we are talking about three sector model. So, when we talk about these three sector models, we always take the role of government. And if there is a role of government, then there would be always taxes, subsidy, and transfer payments. So, in this three sectors model, the government is added to the two sector models. So, in this model, money flow from households and businesses to the government in the form of taxes. Here you can see the government pays back in the form of government expenditure through the subsidies, benefits, programs, public services, and etc. Now, coming to the circular flow in a four sector economy. Here, through a flow chart, you can make a very clear concept that four sector models that is included for rest of the world and financial market as well. So rest of the world we can also refer to as net export. So this is the main part of the comprising of the four sector models. In a four sector economy, the model expands to include a fourth sector, the external sector, or the rest of the world. So external sector, and we can say also rest of the world, export and imports. What does it mean? External sector basically we can also say that export and import, and along with that foreign exchanges as well. So the external sector engaged in trade with the domestic economy, impacting the flow of goods and money. Foreign exchange, the external sector involves currency, exchanges, and international transaction. Therefore, the inclusion of the external sector accounts for international trade and financial transaction, highlighting the global dimensions of the circular flow of national income. Now, coming to the another slides, and now let's talk about what is factor cost and market price. So there are basic difference between factor cost and market price. Here in the slides, in the left uh, chart, you can see that gross, net, national, domestic, market price and factor cost. Now, if I say that how we can calculate, how we can estimate, or how we can get uh, net from gross, domestic from national, factor cost from market price. So these are the formula, basic formula. So now talking, first of all talking about the how we can calculate net from gross. Then in order to get net, we always deduct depreciation from gross. So we will get net. Now, in second point, uh, whenever we uh, whenever we get domestic, we always deduct net factor income from abroad from national income. Now, the word net factor income from abroad, what does it mean? This means that net factor income from abroad is equal to factor income earned from foreign minus factor income paid to foreigners. So the difference between factor income earned from foreign minus factor income paid to foreigners, the this difference constitute what? Net factor income from abroad. Now the last is factor cost. How we can get factor cost from market prices? So we can deduct net indirect taxes from market prices in order to get factor costs. So what is net indirect taxes? Net indirect taxes basically the difference between indirect tax minus subsidies. Here you can see NNP at factor cost. Now by just seeing this chart we can understand easily net national product at factor cost. Now in another sites, we can also see that how we can calculate GNP at market price, NNP at market price, NDP at market price, and so far. So let's try to understand the first formula. GNP at market price is equal to GDP at market price plus net factor income from abroad. So, in order to get gross national product at market price, we always add net factor income from abroad in GDP. So, we always get GNP at market price. Now, second formula, NNP at market price, we always deduct depreciation from GNP at market price because we have to get NNP, that means net national product. So whenever we deduct depreciation from GNP, we always get net national product at market price. Now in third formula, NDP at market price. How we can get NDP at market price? So in the same way, we always deduct depreciation from GDP at market price in order to get NDP at market price. In the fourth one, we can see if we calculate or if we wish to get NDP at factor cost, we deduct NIT from NDP at market price. Now, what does it mean NIT? NIT stands for net indirect taxes. So whenever deduct net indirect taxes from NDP at market price, we will always get NDP at factor cost. In the fourth one, we can see GDP at factor cost. How we can get GDP at factor cost? We always add up depreciation in NDP at factor cost in order to get GDP at factor cost. Now, NNP at factor cost is equal to NDP at factor cost plus NFIE, that means net foreign income from abroad. So when we add up net foreign income from abroad in NDP, that means net domestic product at factor cost, we will always get net national product at factor cost. Now the last one is GNP at factor cost is equal to NNP at factor cost plus depreciation. Now, here we can see in order to understand the net domestic product, this is the basic definitions that I have written. The net domestic product equals the gross domestic product minus depreciation on a country's capital goods. As I told, as I make you understand in the previous slides through formula. So this is the basic definitions of net domestic product. Yet you can also see that net national product is nothing but the net national product is a gross national product, the total value of finished goods and services produced by a country's citizens overseas and domestically minus depreciation. So whenever we deduct depreciation from GNP, we will always get NNP, that means net national product. Now, another slide, gross domestic product. So, what is GDP? GDP is the money value of all final goods and services that is produced within the domestic territory of a country in an accounting year. And in GDP, while estimating GDP, it really does not matter who is producing, either residential and non-residential. Now, the last one is gross national product. So, what is gross national product? Gross national product is defined as the sum of the gross domestic product and net factor income from abroad. Thus, in order to estimate the gross national product of India, we have to add net factor income from abroad earned by, earned by residents in India. So, the formula would be GNP is equal to GDP plus NFIE, that means net factor income from abroad. Now, this is the definition, basic definition, as I already told you earlier, the factor cost and market price. So, factor cost is refers to the cost of production. Cost of production, the cost of factors of production basically that is used in process of production. So this is the flow chart of how we can calculate GDP, how we can get GDP at market price from various factors such as GDP at factor cost, GNP at market price, GNP at factor cost. So if we apply this formula, we can get accordingly. Now, coming to the measurements of national income. So here there are some measurements, that is income method, value added method and expenditure method. First of all, what is income method? To calculate the national income from the distribution side, the income method is used. Thus, when the income is measured during the time of distribution, it appears as the income paid or received by the people in that country. This income in this method is obtained by adding up all the incomes of the people in the country. Services like land, capital, which is produced its own services, are included in these methods. So, if we add up all these payments done by firms, such as payments, rents, royalty, interest, profit, compensation to employees, and mixed income, and as well as net factor income from abroad. So, if we not add net factor income from abroad in domestic income, then this would be only GDP or NDP as you say. But if we add in NDP plus net factor income from abroad, then we will in the position to calculate national income. Now, another is product methods. So product method is also known as value added method. This method of measuring national income is also known as value added method, as I told, or output method. Point to be noted from the name itself that in this method the value added by various services and production goods are measured. For the value added of the goods to be measured, the expenditure that is measured on the intermediate goods is deducted from the goods itself. So now this is the in this slides you can see that the output minus intermediate consumption minus net indirect tax minus depreciation plus net factor income from abroad. So this is the measurement of value added method. There are three methods as I told: national income, value added method. You can also see production method and output method. So now the last one for measuring the national income is expenditure method. So, as this name suggests, this method includes all the expenditure done by the people in that country. The national income in this method is calculated based on the total expenditure made on the services and goods during the entirety of that year. People spend their income on capital goods or consumer goods. So, all types of expenditure are calculated in this methods. Thus, expenditure can be from anyone, from households, private individuals, to government expenses, or the various businesses enterprises. So, this method is used mainly to calculate the income in these construction sectors. Now, we always have to see the precautions. What would be the precautions of national income? So whenever we calculate national income, we have to just focus on this area that we always do not take the part of like double second hand goods while measuring national income, bonds, shares while measuring national income, intermediate goods while measuring national income. So these are the questions that I have taken. Which of the following is a method to measure the national income? The answer would be D, because in the slides we have studied that expenditure method is also a measurement of national income method, and production method. So all of the above is the answer. Now in the second questions, which of the following is the employment theory related to? The answer would be A. Macroeconomics. In the third question, which of the following is the correct term for calculating national income at constant price? So, whenever we talk about the constant price, that means we are talking about real income. So, let me tell you the basic difference between real income. आ गए आ गए